They wanted, when I say they, I'm talking about the administration, the Trump administration wanted to onshore gold because I think it's their plan at some point to revalue gold. And it's obviously much better if you have it on your shore or in your control as opposed to overseas. I view it as what they did was they onshored unencumbered collateral because there's so little collateral left anywhere in the world to borrow against. And if they're going to revalue gold, they want it onshore so that that collateral gets revalued higher here. Once they revalue it higher, then all of a sudden you're going to get, gold as collateral to be borrowed against. So maybe that's their plan for the next inflate or die cycle.
Legendary investor Bill Holter says the Trump administration quietly pushed to bring U.S.-owned gold back onshore. The reasoning was straightforward. If gold is ever revalued upward, the government will want that collateral under direct U.S. control. With gold at home, it could be used in the next phase of financial engineering, restarting the inflate-or-die cycle by revaluing gold and then leveraging it for more borrowing. Holter even wonders if that explains why the Fort Knox audit talks suddenly went quiet. Maybe what they found wasn't what they expected. As for the recent pullback in gold, Holter doesn't see it as a true sell-off. He views it as sideways consolidation. In past years, every push to new highs was quickly slammed back down. This time, the market is holding its ground, an important shift in behavior. Holter also points out that U.S. deficit spending has become a permanent feature. Deficits were supposed to be temporary, used during downturns and offset by surpluses in good times. But the U.S. hasn't run a real surplus in over 60 years. It's been more spending than income every single year. Markets, in his view, are already flashing warnings. Bond yields rising even after rate cuts are not a sign of confidence. They're a signal of deeper stress. Holter expects bonds to weaken again in the coming cycle. And if policymakers dismiss inflation as just one-time price increases, he says that only makes sense under scenarios like tariffs or a full-scale monetary reset. For Holter, gold isn't just insurance anymore. It's the asset likely to anchor whatever comes next. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
The pullback from the highs has really been a sideways consolidation pattern. In the past, we'd see prices break to new highs and get smashed immediately, and that's not happening this time. I think one thing of interest that almost nobody's looking at is the yield on Japanese bonds. And why that's important is because the yen is the carry trade. I mean, that is the foundation for the global carry trade. And you've had yields, you've got 320 or thereabouts on the 30-year and 160 plus on the 10-year. Those rates were 0.2 or lower 2 years ago, and they were about half of those levels, pretty close to half of those levels at the beginning of the year. So yields have really blown out in the Japanese bond market, and the carry trade is becoming unprofitable from its base. And what that means is a lot of the carry trade, the longs, once you get participants closing out the funding side of it, then they close out what they're carrying. So it really does have the potential to blow things up and turn this into a domino market of all markets to the downside, because literally anything and everything has been bought up by funds created through the borrowing of basically a 0% interest currency that's no longer zero. So there is a cost. There's a big cost now for them to carry. They wanted, when I say they, I'm talking about the administration, the Trump administration wanted to onshore gold because I think it's their plan at some point to revalue gold. And it's obviously much better if you have it on your shore or in your control as opposed to overseas. I view it as what they did was they onshored unencumbered collateral. because there's so little collateral left anywhere in the world to borrow against. And if they're going to revalue gold, they want it onshore so that that collateral gets revalued higher here. When I say
Yeah.
here, where they have control over it, where they can use it, whatever, where they can lend it, I mean, obviously once they revalue it higher, then all of a sudden you're going to get, gold as collateral to be borrowed against. So maybe that's their plan for the next inflate or die cycle. He's talking about the economy's growing at 1.2%. What's the growth rate of Treasury debt? What is the number? I'm guessing it grows at what, 7% plus per year?
Didn't they hit over $1 trillion in the most recent quarter?
Well, yeah, they're over $1 trillion on interest paid, and I think for the quarter it was $1 trillion because the first quarter or the quarter prior to that they borrowed way less than they had anticipated and then jammed it all in the first week or 2 weeks of the next quarter. But my point being, if you've got debt rising so much more rapidly than you do the economy, the real economy, to support the debt, to support the cash flow and thus the interest payments. It just seems to me that that's a mathematical equation. You can't do that. And we've known this for years that, any household that operated like the Treasury would be either bankrupt or in jail. So I think you need to ask yourself the question, if we're running a deficit of $2 trillion per year on an economy, what's the size of the economy now? Close to 30 trillion?
Yeah.
That's 6-7% deficit per year. What would the economy do, or what would it have done if it wasn't for that additional spending of the $2 trillion that was borrowed by the Treasury? What would the economy have looked like over the last 10, 20, 30, up to, call it 60 years or 60 plus years? Because we've deficit spent every single year. My point being, deficits were supposed to be used during bad times to goose the economy. And then we were supposed to run a surplus during good times to save up for the hard times. Well, for 60 plus years, it's been nothing but deficit spending. And I would ask you, what would the economy look like had there not been any deficit spending? He's talking about cutting rates, but inflation could be a problem. It's what the market's already told them a year ago when market rates went higher and after they cut interest rates. I suspect that's going to happen again. I think we're going to have a weak bond market in this cutting cycle. And it's math. If I was there, if I was a journalist asking questions, there's so many questions you could ask him. But the biggest one of all isn't inflation a result of monetary policy?
I don't think he believes that, or at least
inflation is a monetary event. Now, one thing he said was a one-time price increase. The only two things that could come to mind would be all of a sudden stuff costs more because of tariffs, or is he talking about a reset?
Bill Holter says the Fed always leans on CPI and PPI because those are the official government numbers. But if you really want to see inflation, he argues, just look at the markets themselves. Global stock indexes have been inflated for years, and interest rates are still far below historical norms. That gap is its own form of inflation. It shows up most clearly in the bond market, where decades of cheap money pushed prices higher than they ever would have been otherwise. The Fed doesn't call that inflation, they call it a bull market. But Holter says it's the same thing. Prices rising far above where they'd be without monetary manipulation. He also notes how much government policy shapes entire industries. When an administration decides to favor one sector, the results are immediate. Trump, coming from a business background, understands this dynamic well. He knows market prices can be gamed through leverage, derivatives, and speculation, but he also knows the real bottleneck isn't financial, it's regulatory. permitting and oversight often decide whether resources get developed at all. Holter says Washington is slowly being forced to face a simple truth: you can't conjure real supply out of thin air. Paper contracts may move markets in the short term, but they don't create oil, copper, or gold. At the end of the day, you still have to dig it out of the ground. Let's get back to the interview.
And one thing you'll never hear a Fed chairman talk about is they constantly talk about CPI, PPI, because those are the government figures. I would say all you need to do is look at markets themselves, and there's your inflation. I mean, you've got inflated equity markets all over the world. You have interest rates way below what would be considered normal historically, going back hundreds of years. The low interest rates are inflation, if you will, in the pricing of bonds, because there's so much capital out there trying to find a home. So there's your inflation. I mean, yeah, it sucks when you go to the grocery store and stuff costs more, or gasoline costs more, or you're paying somebody more to cut your lawn or do work or whatever. Yeah, that's one form of inflation. But the one form of inflation they'll never tell you about or talk about is inflation in asset pricing. They call that a bull market. That's good inflation. But again, it's inflation nonetheless. I mean, becoming a listed critical mineral, it seems to me like somebody's waking up in Washington to understand that you can't create supply by creating paper contracts. They understand, you got to dig for minerals, you got to drill for oil. I mean, it's a physical anomaly, if you will. I mean, it's not something that they can create with paper. It's good that somebody in Washington is realizing that. I mean, they did that with other rare earth minerals. I mean, there's all kinds of things that the United States needs to really get to work on, and should have been to work on 5-10 years ago with the way that our supply chains are. I mean, we rely on enemies for things that we need to make war. And that's a ridiculous supply chain. If you have an administration that's friendly to an industry, it makes working or competing in that industry easier, because you've got a government that favors it and is cutting as much red tape as possible. And that is one thing about Trump as a businessman, is he understands. You don't look at the price of something, because the price can be painted, can be manipulated, can be altered using leverage, using derivatives. But getting it out of the ground, he understands the permitting process, if you will, with all the buildings that he's put up. So I think he understands that the permitting process is huge. One thing he's certainly not followed up on. Look what's going on in California. I mean, what is there, 5 houses now total that are under construction from the quote wildfires? I mean, talk about red tape.
Yeah.
You only got 5 houses out of thousands. What was it, 13, 14,000 houses? I forget what the number was, but you only have 5 of them that are able to rebuild already because of the red tape. And that's what they're doing, I think, with the mining industry, is cutting the red tape, making it easier to get product or projects started and moving along.
What's unfolding is less about daily market swings and more about the foundations beneath the financial system. Between government efforts to quietly repatriate reserves, the normalization of persistent deficits, and signs of strain in bonds and currencies, the indications all point to a world edging toward a structural reset. Gold, once dismissed as outdated, is increasingly being positioned as the bedrock for whatever comes next, whether through revaluation, collateralization, or simply as the last form of trust in a system overloaded with paper promises. The consistency of these moves across governments, investors, and institutions suggests this isn't random, it's preparation. And while the broader public debates interest rates or short-term price movements, the real game appears to be happening at a much deeper level, where long-term positioning matters more than daily charts. Could this quiet repositioning of gold be the clearest signal yet that policymakers are preparing for a financial framework built on different rules than the ones we've lived under for decades? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.